All right, let's get right into it. We're going to break down a really interesting analyst report on Microsoft's latest quarterly earnings. We're going to peel back the layers on their financial statements because there's a fascinating paradox hiding inside the numbers.
So let's just start with this number right here, 0.66%. According to the report, this is Microsoft's run rate free cash flow yield. Now, what does that mean? It's basically the annual cash profit the business is kicking off for its owners compared to its massive price tag on the stock market. And honestly, for a company of this scale, that number is shockingly low, which brings us to the big mystery we're going to solve today.
So yeah, how is this even possible? You've got one of the most profitable, most dominant companies on the planet. How is it producing so little actual cash for its owners right now? That's the question, and we're going to find the answer by walking through this analyst report piece by piece.
Here's our game plan. We're going to start with profits. Then we'll follow the money to see exactly where it's all going. After that, we'll dig into their future revenue promises, connect all of that to the stock price, and then wrap up with the report's final verdict.
First stop, earnings. Whenever you're trying to figure out how healthy a company is, profit is usually the first place you look. But as this report makes very clear, not all profit is created equal.
Okay, so what you're looking at here is a pretty massive gap. On the left, you've got the official, by-the-book GAAP profit of $38.5 billion, which grew an incredible 60%. But then on the right, you have what's called the non-GAAP number. It excludes certain items, and it's way lower at $30.9 billion, with a much smaller 23% growth. That's a $7.6 billion difference in just one quarter. So what on earth is going on?
And boom, here's our answer. The report pulls this quote directly from Microsoft's filings. It turns out that the big official profit number got a huge boost from a one-time, non-operating gain related to its investment in OpenAI. This immediately raises a huge question about the quality of those earnings. Is this profit coming from the actual day-to-day business, or is it from a financial event that won't happen again?
So if the main profit number has some noise in it, the next best place to look is the cash flow statement. This thing doesn't care about accounting rules, it just tells us how much cold, hard cash the company actually brought in the door.
And this chart, this gets right to the heart of the paradox. Look at that first bar. Microsoft generated a massive $35.8 billion in cash from its operations, up a whopping 60%. That's amazing. But then look at the second bar. The company immediately turned around and spent a staggering $29.9 billion on capital expenditures. Think servers, data centers, all that stuff. So after all is said and done, you're left with that tiny third bar, just $5.9 billion in free cash flow.
The report has a name for this, Capex Intensity. This quarter, it hit 46.1%. To put it simply, for every single dollar in revenue Microsoft made, it plowed nearly 46 cents right back into building more stuff. This insane level of reinvestment, mostly for its AI infrastructure, is the main reason why free cash flow was actually down 9% from last year, even while operating cash was surging. The business is a cash machine, but it's pouring that cash right back into the ground.
Okay, so far we've got noisy earnings and squeezed cash flow. But what about the future? The next clue in this puzzle comes from looking at the company's backlog of contracted business. This is what's called the remaining performance obligation, or RPO.
And the number here is just astronomical, $625 billion. This is revenue that customers are already locked in to spend with Microsoft down the road. It's up 110%, which on the surface looks like an incredibly powerful sign of future growth. But the report says, hold on, let's look a little deeper. And this is the kicker. This is probably the most critical finding in the whole report on this topic. Almost half, a full 45%, of that enormous backlog comes from just one customer, OpenAI. This isn't subtle. It's a huge, explicit concentration risk. That giant number looks great, but its stability is heavily, heavily dependent on the success and spending of a single partner.
So, let's recap. We've got a mixed bag, right? Profits are a bit fuzzy. Cash flow is being reinvested at a furious pace, and the future backlog is huge but concentrated. Now we get to the big question. What is the current stock price assuming about all of this?
Well, according to the report's math, at a price of $480 a share, the market is paying about 29 times Microsoft's run rate non-GAAP earnings. And remember, we're using that more conservative earnings number because the other one had that big one-time gain. A multiple of 29 is, well, it's not cheap. It means the market has very high expectations for future growth.
So the report runs this really simple what-if scenario. What if the market just chills out a little bit and decides to pay a lower multiple for those exact same earnings. If the PE ratio drops to a still pretty healthy 25, the price would fall to $414. If it drops to 20, the price would be $331. And if it came all the way down to a more old-school, conservative 15 times multiple, you're looking at a price of $248. It just goes to show how much of the current stock price depends on keeping that premium valuation.
All right, let's tie this all together. After digging through all the numbers, what's the final verdict from this analyst report?
The report is actually very balanced. On the one hand, you can't deny the strengths. The business is incredibly profitable, the cloud momentum is just unstoppable, and that $625 billion backlog is a monster. But on the other hand, you have some very clear weaknesses. The quality of the reported profit is a question mark because of those one-off gains. Free cash flow is getting squeezed hard by all that spending, and the backlog is seriously concentrated with one customer.
And this brings us to what I think is the most useful part of the report. It gives you a literal watch list of things to monitor. You need to keep an eye on that other income line for any more funny business. You watch the cloud gross margin to see if that 67% holds up. You track Capex to see if it ever slows down. And of course, you watch that free cash flow trend and the concentration of the RPO. These are the tells. These are the indicators that will signal where this story is going next.
So in the end, the report leaves us with this one big question. Microsoft is making a gigantic, company-defining bet on AI, and it's reinvesting nearly every dollar it makes to win. The stock market seems to be giving them full credit for winning that bet before it's even over. The real tension here is whether the price is getting way out ahead of a story that just hasn't shown up yet in the one number that matters most to an owner, free cash flow. And for that, only time and a close eye on the numbers will tell.